live again for another YouTube installment. We are, what happened today? Anything new in the market? Oh, Bank of Canada came out today and did a 50 basis point rate hike again, another rate hike. So that would mean that TD, Bank of Montreal, CIBC, all the major financial institutions in Canada are going to now jack up to, I guess, 6.6% prime bank rate. So if your HELOC was prime +1, you'd now be 7.6% interest. If you have a car loan that was prime +2, you're now going to be probably around 8.6% interest. Mortgages are continuing to float up. However, the spreads have gone down as markets have continued to price in, or I guess a lot of people are bullish on the fact that there's the possibility for rates to come down into 2023. And I think the market's probabilities of things coming down into Q1 2023 has been dropping though. We were, by summer, everyone was like, you know what, by Q1 2023, like January, February, March 2023, everything's gonna be back to normal, all good. Rates start falling. It's now looking more likely like there'll be a pause and we might, maybe, get rates coming back down into 2024. I don't think 2023 will see any major rate dropping action really to get us back to where we were earlier this year in 2022. I think it's going to be a while before we see those rates that we saw in January as an example of this year, February as an example in this year. So rates can't stay this high for very long. They could, but it'd be a lot of pain. It would eventually crash the market. So they are treading carefully. It was a possibility the Bank of Canada would have come out today and did a 25 basis point or 0.25% hike, but they went with 50 BPS, and so it's really 50 is the same as 0.5%. So 0.5% rise today. I think they're going to hold off. It seems to me like, you know what's funny? You guys know, you've been following me here. I've been short almost the entire last 2 quarters. And I went to neutral during this rally here at like 290 QQQ. I just went to like pretty much the equivalent of neutral. So that means I'm not really long, not really short. And then the market drops 4.5%. We've lost 4.5% on the NASDAQ, worse on the Russell 2000 in the last 2.5 days of trading. And so we've seen quite a bit of a pullback where the QQQ was, dancing with, 279 today. And so it's like, it's not inconceivable that when we have a really bad earnings season next quarter and the quarter after, as if inflation did slow a little bit, these higher interest rates are going to lead to layoffs, which will lead to lower spending. And of course, less inflation means less record growth. And so we'll have bad quarters. And when we have those bad quarters, I think things could I do honestly believe that when we're talking about the stock market, I'll get to real estate in a second here, but I think in the stock market, we really could see a retesting of the lows of 2022 and potentially even lower. I think the lows were like 255 on the QQQ and the NASDAQ. It's the ETF that follows the NASDAQ. So I think we could see a retracing of that again this year. And I think it's possible that into 2023, we see more slippage under that price and potentially even lower. So that's where I'm going to go long. I'm going to be bullish. And you'll probably see me go 2 times long, at least, maybe 2.5 times long with hedges in place. So I'll be riding that recovery because, again, we're going to go further down. But at some point, you got to get in, you got to pick a bottom. And it's impossible to time it perfectly. But I feel like all the things have not been felt fully. I feel like there's still a lot of pain to come. And real estate, of all things, lags. So there's a lag between the pain felt in the stock market and the bottom of the market in real estate. In the beginning, cash buyers come in and they buy up a lot of the demand for properties satiated by all the cash buyers have been sitting on the sidelines. So they got to use up all their cash. The people who are now trying to finance things, they're waiting. Rents are still up. There's on the real estate side, we are still seeing, further drops in price. It's starting to plateau. We've kind of hit what feels like a bottom, but we could go lower, In Ontario, it feels like there's not much more we can go. We've wiped out the last 30% of gains we had in the last year and a half. So could it go lower? Yeah. We could see more pain. I think it's more likely that we see a choppy 2023 that's mostly flat. And I think it's possible that even in 2024, we could see some flatness. Some segments of the market are doing well. Some areas, certain properties are still selling and doing well. In the luxury space, people still have a lot of money. So if you're a high-end focused, property, you'll be okay. The lower end too, I think, will do well because people who are priced in at, like, say, a $500,000 house might just adjust their budget now to look at the house at 350. And so the person who's got a $300,000 house in a market where the average house price is 600, you'll be doing just fine. So that's where I would focus my energy and my time is on those types of properties, cash flow focused properties. If you buy, just like, this is the important thing to remember when you're buying stocks, buying real estate. The general consensus is don't short, don't sit in cash. The general consensus, right? Because inflation eats you. Over time, you buy quality assets that produce cash flow and you win. It's like a guaranteed thing. Over a long period of time, you always win. So that's what you want. You want to be buying quality assets, and then 5 years from now, you'd be thankful that you did. Almost all the time in 5 or 10 year period, you win if you diversify and you buy quality assets. So diversification is important. Don't put it all into one property, one location. Try to spread it around if you can. By the way, guys, this is a live Q&A, and I didn't have a good title today, so our viewership will probably not be as good because, again, when I don't keyword properly or I don't put the right keywords into my title, then we get less viewership. And anyway, so here we are. I'll go to the Q&A for a sec here and see what's up. So Eric says, hey, just passed my real estate exam. Please talk about investing, private lending in London. Excited for next year. Right on. Congratulations. That's awesome. I think the real estate licenses can be a great gateway into, exploring the real estate world. If you love real estate, then go find someone who's, a great top producing in your real estate agent. Go find someone who's a top producing real estate investor or real estate agent even, and go work for them. If you're an agent, you say, hey, look, I'll go show all your listings for you for free. I'll go do photography for you for free. Whatever they need. Do you need me to do some paperwork for you? Like, whenever you're doing a deal, I'll just be your lackey and I'll be a fly on the wall and just do all the heavy lifting that you don't want to do. And I'll do it for free. And most of these top producing agents will take you on. They'll realize how valuable you are. And once you're a part of their systems and a part of their life, they'll pay you because you're making their life easy. But even if they didn't pay you, you would learn so much. And the value of all of those learnings is worth so much, and those connections and all of that. So that's what I would do, is try to find someone who's really great and shadow them if I was just getting started. So that's the advice I'd have. As far as private lending, here's my advice for private lending. It is one of my favorite asset classes for 2022. Using a bit of time and effort and skill, you can procure some marketing materials, network at real estate investing, events, and find people who are desperate enough to pay really great rates. But this is the important thing. You can go find extraordinary rates and get returns that are higher than you're going to get in the market at a lower risk level. But, and again, because interest rates are so high right now, you can get a great return. I would argue in this market now, you can get a 12% risk-free. 10 to 12% risk-free return. We'll say 9 to 12 risk-free, depending on how conservative. I know there's some viewers of mine that are really conservative, like GIC type investors. And for those folks who are the GIC investors, I shared some stories on my Instagram at Mike Rosehart about that. And it was a whole thing about, I even talked about the idea of flipping mortgages. You can definitely do that. People think you only flip real estate. You can flip mortgages too. I've been talking about it for a few years now on my social media outlets, and no one talks about it. Like large funds, they do this all the time. They can't invest heavily enough in marketing. So they'll say, hey, if you go find properties, say 5% loan to value, get nice quality appraisals, from a reputable appraisal company, and you go lend on that 75% loan to value, you get a mortgage, say at 12%, you can go flip that piece of paper on day 2 after funding to a fund that will be happy to get an 8% return and will pay you back all the money you lent out. Maybe you did a lender fee too, and you get to keep that lender fee for yourself. So that can work out to like 1,000% ROI annualized. So you keep that lender fee because you set the deal up. You sell that mortgage to them. They buy it from you. You just sold the mortgage, the underlying mortgage. Now the mortgage payments get routed to this new party. They buy that mortgage from you, and they might buy it at 8%. And so they might pay you 4% up front. You get a 4% return in one day on your money. So you put $1 million, $1 million up on a mortgage, and you get a 1% lender fee. It could be $10,000 in profit right away if you're setting the deal up. You were going to get 1% a month, so 12% annualized on that deal. Maybe you're funding a flip for someone, and they just want easy, and rates are so high with the bank, 6%, 7%, 8% anyway, that why not go to a private source for 12 and there's no paperwork, no stress. They just check the property out, they underwrite the deal, boom, it's done. So that can be a great option for flippers or for people who are repositioning assets, looking to burr it. And so by the end of the burr, it's actually cheaper than trying to break a mortgage and refinance and worry about the seasoning period. Good real estate investors who are good operators can make money while paying 12, 15% interest on these notes. So there is a huge market for it. If you can find that and tap into that market by going to real estate networking events and just advertising, you have capital to lend out, people, you'll find people, they'll borrow it. Your job is to underwrite. If you don't underwrite properly, you can lose a lot of money lending. Be very careful. I'm doing a foreclosure right now where I didn't underwrite properly. By that, I mean, I relied on a broker to bring me the deal, and they were a sleazy broker, and they misrepresented the facts. They lied about they knew full well that the person whom they were bringing to me didn't have enough funds, and they faked documents and things. So I'm in a mess with that right now. There were some things where they didn't have the funds to put down. They borrowed from loan sharks and things. It's just a whole nasty story. But don't do that. I will probably get most of my money back, even in this declining market. I probably won't lose any money, but still, it's a nasty situation to have to pursue that. So learn from that mistake and underwrite the hell out of your deals, which means you need to be looking to make sure that you get a great loan to value, that you're sure of the value of that property, get second opinions, et cetera, so forth. Make sure that the client that you're lending to is solid, because you don't really want to default on them. You ideally would prefer if they, were had a quality property, all of these kinds of things, quality borrower. That's really important. And so it's, do they have reserves in cash? What's their plan for the property? All these kinds of things. Do your due diligence to find out and think through. I have a video I did probably 3-4 years ago. You'll find it on there about, you type in private lending, Mike Rosehart, you'll probably find it. And it's me at a whiteboard, and I go through like the 15 lending criteria things that I look for. But I didn't. I lapsed in judgment. This person needed funding. It was a bridge mortgage. They had a new mortgage set up. It fell through. Part of it is this market, right? Like, people are getting declined left, right, and center. So it's hard to get financing right now with the banks and with the larger institutions. And so stuff didn't pan out the way they wanted. Real estate prices dropped 20%. Their equity was gone. Little did I know they had borrowed that down payment, even though they said that they had those funds. They borrowed them. It was a whole situation. I'll be okay because I underwrote a quality property. So even with the market dropping 25, 30%, I lent at a low enough loan to value. I should be okay. Might lose some interest on it. It's going to suck, but my principal is safe. Again, I should have underwrote better. If I'd underwritten better, then I would have no risk right now. So underwriting really quality deals, safe loan to values, looking at the borrower is super important, making sure they have solid credit scores, good jobs, that you can garnish income, lots of assets, that things go south with this deal, you can go after them, you have recourse to go after them. So those are all things to underwrite. But going back to that example of how you'd flip a mortgage, you get that mortgage, the example I used was a 12% rate of return, let's say, that you locked up, and a 1% lender fee for yourself. Pretty easy to find those kinds of deals these days. It's not even a unicorn, really. I would say a unicorn is 15 to 20% for a 6-month or 12-month mortgage term. If you're getting into second mortgages, you can charge more than 20%. But again, don't do that, because the only time I'd ever do a second mortgage is if the loan to value on the second mortgage was like 70%. Because in second position, you have very little control of the deal. The first has to default, take control of the property. The second has very little recourse. So you're in second position. Your hand's out, and the first person gets paid first. You get whatever's left over. And then the equity is like, that's the least secure. So lending is actually safer than buying property. You'll buy a property in cash, and the market goes down 20%, you lose 20% on your investment. You go lend that same amount of cash, 75% loan to value on a property, the real estate market collapses, goes down 30%, 25%, you've lost nothing, zero. You put 20% down on a property, you're in the equity position, the bank takes, or the mortgagee, let's say, the mortgage person is taking 80% loan to value. That person who's the lender, they're going to be in a position where your equity dissolves first. The market drops 20%, your equity's gone. You got 100% loss on your money because the property fell 20% in value, 20%, that 20% is your equity, gone. Their money's protected. Property goes from being worth 500 down to 395. If their mortgage was 390, you put in 110,000, your 110's gone. You have 100% loss in your money. In fact, you can even be in a negative position because of leverage, right? It's a great thing when you're holding cash flow in real estate. The loan never gets called, but if you're flipping, then it's not a long-term product. You might be in a situation where you would have challenges to go through, right? Through those times. We're seeing those people default right now. I'm seeing lots of real estate investors that are underwater right now. I see I hear tons of stories from real estate agents calling me and saying, hey, we're in a situation right now where we've got a client who, put a first on it and a second on it. They only put 10, 15% down. Market's down 30% in some areas of the GTA. It's like, well, now this property is underwater. The second mortgage can't get paid back. They can't even sell the building and pay the lenders back. So the lender's got to decide what to do. Do we just foreclose, take everything he has, and then sue him? So now he's working a job for the next, I know situations of people who are working jobs, who will have to work jobs now, full-time jobs, to pay the lenders back on deals they did because they didn't underwrite the deals properly. As the lender, hopefully you underwrote properly. And again, even as the buyer, hopefully you're underwriting the deals properly, which means you're doing the right amount of due diligence and analysis on the properties. Even myself, I bought some properties earlier this year, and my flip profit won't be as strong as it should be because I bought stuff in the summer and the market continued to fall under 10, 15%. It's fine because they're properties I can hold for the long term. I'll win long term. It's like if you buy shares in Meta, as an example, at $120 a share, which is cheap compared to $300 a share earlier this year, and then Meta dips to $90 a share. That sucks. 120 down to 90. But if you believe in the company and you believed in it at 120 and it comes back to 300, let's say in the next 5 years, you don't care that you bought it at 120 instead of 90, right? You can hold the property. It's producing cash flow. That's the idea behind buying stocks, behind buying properties, right? Diversification in stocks is super important, guys. Don't buy just one, just don't buy one company, buy one stock. Buy the indexes, be diversified, spread it around. Don't play around with like 3 stocks. That's dangerous. Anyway, back to lending. So you take that. Now I'm talking about lending flipping for a sec here. So this is a really cool business because you can take that $1 million note, you can sell it to someone else. Now a bank or another person might be, they don't want to do the work, they don't want to go network, they don't want to go find opportunities. They've never heard about, never heard about any of these 12% opportunities before. To them, a 5% GIC is attractive. So they see an 8% almost risk-free return, by the way, because a GIC's level of failure, you got to remember that the banks fail at a 5 to 6% default. They become insolvent. So if you have 5 to 6% mortgage default across the board, CIBC, major banks, insolvent. So that's full collapse. And by the way, if you do the math right now, mortgages renew about 20 to 22% in any given year of all fixed rate mortgages renew. So in 2022 and 2023, we're going to get about 40% of all fixed mortgages renewing. And when they renew, they're going to be hit with a new rate when their old rate was 2% on a 3-year fixed or a 5-year fixed or whatever it was. And now their rate is 7%. That's shock. That's 250% higher mortgage payments. There will be defaults. There will be blood in the streets. Another 55% or so of all the originating mortgages from 2020 to now were variable in nature. And a lot of them have reset. They're fixed variable, but they've reset now, where the interest has become so much that the mortgage payment that used to be principal and interest is now entirely interest and still not enough. So they come back to you and they say, hey, you need to put money down this mortgage or your payments are going to increase. And usually they just negotiate a payment increase. And so payments are going up all across the board. That's going to lead to higher defaults, especially if rates stay this high for long. People initially won't lose their house. They'll borrow on their line of credit till the line of credit gets maxed out. And then they're paying higher rates of interest on their line of credit. They're paying, prime plus 3 on their line of credit, killing them as they try to cover their mortgage that's now double. There will be defaults. So anyway, the bank will step in and have to bail that out. So GICs have a level of risk. I know they're considered risk-free. There's still a risk there. In real estate, if you have a 50% drop in price, like remember, we've already dropped 25, 30% in Ontario. So if you're lending on properties today, 70% loan to value, today's value, you're really talking about a 50 to 55% drop in value of properties from where they were in February of this year. That won't happen. There's only so much further prices can fall before the government steps in. We have full economic collapse. It's in Canada, one of the largest leading overall wealth effect and overall GDP contributors. So real estate is essential in Canada. For that reason, I believe that currently lending 70% loan to value at current values, which is a lot like lending at 55% loan to value in February of this year, will produce a risk-free return. And if you can get a higher return laying at those loan to values, which you can, there are people in Toronto who've got $3 million houses with no mortgage on them. And they're doing a deal over here and it's going sideways and they just need $1 million quick. And they don't care, it's just a short-term thing. They'll throw their other property up as collateral. Maybe you could blanket mortgage it. A blanket mortgage is when you take, say they're buying a flip and you're like, hey, I'm just not comfortable. Like I'll fund 100% of this flip. This happens all the time. People call me, say, hey, I don't have any money to buy this deal. I want to do that. It's a great deal. It's half price or something, whatever. The amazing deal that they found through their uncle's cousin. And they want to flip this property, make 200 grand in profit. They're like, but I don't have any cash right now. I'm like, okay, I'll fund 100% of the deal and I'll fund the renovation. Just throw your house into the mix. We'll blanket mortgage both. Done. Super easy. I'll advance you enough to buy the whole property 100% and I'll advance you for renovations too. You put no money in the deal. But I get their house as security too. So that's a situation where like I'm feeling really good about that. I could take that note and I could sell it to a fund if I wanted to, in theory. It's a lot of work to find the buyer for it, but if you have the network and you built it up, you can then sell that mortgage note, obviously flip it, same way you flip the property, and they'll pay you cash up front. So imagine you did that with $1 million and you get 1% lender fee, which is a normal fee to set up the mortgage, it's part of the closing costs. You get 10 grand coming in, boom, right away. And then you'll get your prorated interest for a couple days if you had it for a couple days before you sold it. Plus, you'll now sell that note that's going to produce $120,000 in interest in 1 year, right? So what you do is you say, hey, I'm going to discount the $120,000 you're going to get. You pay me, $30,000 of interest right now, and I'll sell you this note. So I'll sell you this note for $1,030,000. So I sell the note, $1,030,000 day 3. I put $1 million in, I get the $1 million back, plus I made $30,000 instantaneously, plus a $10,000 lender fee. So I made $30,000 plus $10,000 plus a little bit of interest, probably something like a 4.1% return in 3 days. If you annualize that, that's like 400%, and you go to another deal. So you can get 2 deals done in a month and then sell that deal too. So if you were to flip mortgages, in theory, if you had a good deal flow, that's tough to do. Again, I also fund deals. So if you guys need deals funded, reach out to me. I can find the money. If it's a more attractive enough deal, we'll put something together. I'm happy to do the deal, right? Because getting that kind of return is great when it can be close to risk-free. So very, very attractive. Very attractive to set those situations up, and that's what you do that's the ideal lender's flipper scenario. So yeah, little did you know you can sell a mortgage. So people talk about liquidity. Oh, I like GICs because I'm locked in for 6 months and I know I'm getting the cash. It's like you can set up a 6-month term on a mortgage. You can sell the mortgage if you need liquidity. If you really need the liquidity, you can sell a mortgage for a few pennies on the dollar, and someone will take it at a slight discount to face value, like a bond, and you can trade it. And if you get really, really good and you build a lending fund, this is something I'd love to work towards someday with my own personal capital. It's literally on my bucket list, is to build a fund where I'm funding a whole bunch of deals like the bank, but I'm like the more expensive, nimble option. The option that's not going to take you through, 1,000 documents and ravage you for 45 days trying to get financing approval. And maybe for the guy who has 10 properties, so the bank says, no, it's too high risk. Most of the banks, by the way, when you get to like 10 properties, they're like, no, it's too high risk. And then you're not big enough for commercial. So you're stuck in a rock and a hard place where you're looking at B lenders. You come to someone like me, I'm your partner all the time, you just call me, I'll fund every deal. Done. Like if I find a good operator and I know that they do good quality work and good deals, we can set up a relationship where I fund all the deals. And it's just easy. And the time savings makes up for the extra interest that they're paying. So it's a win-win for everyone. You set up those kinds of things. You could fund a flipper. You could see flippers go from 100 grand in net worth to $1 million in net worth. And you can be part of that journey. That's what I want to do. It's one of the things I love to build out as a product of mortgages, different types of mortgages where I'm using my own capital primarily to lend out to different flippers and different developers, real estate developers, even just standard deals, all that kind of stuff, for BRRRRs, that kind of thing. I would be a stabilizing product. Like I'm the short-term bridge, the stabilizer. When a property's got a rough tenant, it's like a smoker and it's nasty, and the bank walks in and says this is not habitable, they're a hoarder, and the bank they see the appraisal and they're like, nope, we're not gonna touch this property. Happens all the time. Or like there's a bad roof and the bank's like, nope, we don't want to touch this property with a 10-foot pole. I'll go in there and be like, put a roof on it. And they're like, yeah, of course I'm gonna put a roof on it. I'll lend it, no problem. And then I make sure they put a roof on it. You know what I mean? Like it's as simple as that. And you can solve those problems, make it habitable, go back to the bank, get a good refinance. But you couldn't get a lender bank because there's something wrong with the property. And that's why, and maybe that property is like, maybe it's $10,000 cash to evict that druggy tenant. Maybe that's all it takes. Maybe it's a hoarder's house, you gotta clean it up. Like little things like that can make big differences, and there's a huge equity upside for the buyer, but they just can't find a good lender to work with. So I would love to have a fund. My sort of end state would be having a nice fund. I hire people to manage the fund for me, so I have staff that do a lot of this. And be in a situation where I'm getting a 12% compounded return, but then I go and take that to the bank and say, look at my product of mortgages. So I got $100 million in a book of mortgages, and they go underwrite all the deals. They go say, hey, here are the terms of the line of credit. They send me up with a line of credit, and they say, hey, we'll let you securitize those mortgages. Meaning the bank will see them as assets and lend against them as assets, which they are assets. If you have $1 million security against a property in Toronto, 60% loan to value, that's like a GIC. The bank lends against GICs 90% loan to value. You take a GIC to the bank, take a stock to the bank, they'll lend you 70% loan to value against that stock. They'll set you up a line of credit, secured against those stocks, against the GIC, against whole life insurance policies too, any assets they'll securitize, and they'll lend you against them. So you take those mortgages to the bank and they lend you back. Now in a lower interest rate environment where I'm getting a 12% return, and let's say the market rate falls to, the prime's around 4. Now that kind of spread is interesting at a prime rate of 4 and a return of 12. Now I can take the bank's money and I can lever up. Say imagine you had a $10 million fund, just hypothetically, lent out different products. $10 million would generate you, what is that, like $1 million? No, $10 million would get you like 12% return on that. You're looking like $1.2 million a year in interest income. But you can take that $10 million and you can go get a line of credit from the bank for $7 million against that $10 million portfolio. Now your $10 million is buying $17 million in mortgages. And because the mortgages are all producing 12%, now you're getting an extra $7 million to deploy into the market, bank's money at 4% cost, you're lending it at 12, and so you're getting an 8% spread on that $7 million. That's $560,000, 7 times 8, yeah, $560,000 in extra interest income that you're gonna get into your corp. So now you're going from 1.2 million in income to 1.7 million after the cost of the interest on the bank's line of credit that they gave you. So now the bank is subsidizing your average cost of funds is dropping like a real bank. And so that would be like my ideal. I know some people think that's like not a great business. It's a lot of work to do. I would do my own appraisals in-house. I'd have my own appraiser that I could trust. I'd have someone who's pulling our own comps. Honestly, appraisers suck. So like I would be pulling our own due diligence to underwrite the deals. Again, you need to have like an accounting department set up. You're basically like a small bank. But again, I would not be servicing I wouldn't be going after the same target segment. My target segment would be flippers, it'd be arbitragers, it'd be, BRRRR type investors, people looking to stabilize property, something wrong with the property, some stigma. Maybe they value their time. Someone like me, like if my time's $1,000 an hour and I have to literally spend 100 hours to get a bank mortgage, what is that gonna cost me? 10, 20 grand to get a mortgage in my time? I can just do a deal in that time, make 20 grand. It's actually better for me to go to a private lender and pay them 10 or 12% interest than it is for me to fuck around with the bank. The math actually supports me spending that extra time I would have spent going back and forth with, bank statements, and they want to see this and they want to see that, and leases for all your properties, and they want to audit 90 days of rent on every single property that you own, and they want to come back and audit your stock accounts and your RRSPs, and they want to look through your credit score, and they want to do it. And yeah, I got approved. Like I have good profiles, so like the result, some people go through all of that and they still get declined. So they wasted their time, they got nothing. They still have to go to B lender 2 weeks before closing. I get tons of stories like that. People mess up, something happens, a car payment bounces, and they had great credit, they had 800 credit score, and something happened, they messed up, they missed a credit card payment, their score drops 80 points, like just temporarily, it's gonna shoot back up, but now they're declined by the bank. Or something happens to the appraisal and like a tenant refuses to let them in, or they're like smoking drugs in the unit, and all of a sudden that appraisal's stigmatized. Sometimes a student rental, it's crazy. Like there was a student living in a unit and the appraiser writes on there, student rental. Oh, bank won't touch it. BMO says nope, TD says nope. All the banks say nope, and now they're screwed 3 weeks to closing. What are they gonna do? They love the deal, they wanna close on it, it's cash flow positive. They're gonna get sued if they don't close. It's a lot cheaper to go find a private. And if they know me and they've worked with me in the past, they continue to work with me, right? And so I wanna be that person I wanna help people solve problems where they make lots of money, I make lots of money. It's a win-win situation. So that's something I would love to do. I also love buying properties. Like my other favorite thing is buying properties. And so I'll always have an acquisitions arm. Probably I'll do some wholesaling as well, where I find great opportunities in properties. I punt them off to people who want to do the work. I'm lazy these days, so it definitely makes sense to punt off, a deal. If there's $100,000 upside, but I got to put in like 1,000 hours fighting with tenants to get them all out. Some young kids, like, 30 years old, like me, still has energy, just getting into this, let's just say, maybe say 25. They got lots of energy, got a great job. Like, I'd love to take that project on for the next 3 months to make 100 grand. They're smitten by that. And I'm like, tell you what, I'll wholesale to you for 25 grand. Boom, I take 25,000 with the upside, they make 100 grand. I could have made 125 doing it by myself, but I get to make 25 with no time investment. That's a win. Maybe I finance their deal too. I put financing, I say, hey, look, you put 10% down, 20% down, securitize your other rental property with me, do a blanket between the two properties. You don't care anyway, because a second mortgage on that property doesn't affect you at all. A lot of people bought properties at good discount values, and so they have a really great amount of equity in the property. They weren't going to refinance that property anyway, so putting that other property up for collateral, It's nothing, doesn't affect them at all. Now they can get into another deal with no money down. And I'm winning because I have great security. Between the two properties, I'm still at my 75% loan to value. And I might have a second mortgage on another property, which is not as safe, but they've just tapped into equity. It's sitting there. They didn't even realize they had. A lot of times people call me, they have equity in properties they don't even realize they have. And so they could do another deal and make another 100 grand. And so we can do that for people. That's a win. So something I want to do. Rosehart Capital is going to be one of the businesses that I focus on. Again, just because like sustainably speaking, it takes a lot of energy and effort to get a 13% compounded annual growth rate. 13% compounded annual growth rate allows me to be billionaire before I'm too old to enjoy it. So all I have to do is just grow at 13% compounded. It gets harder as you get bigger, but just keep growing 13% every year. That's what I gotta do. So I have some investments that'll lose money, like crypto right now. HODL, don't look at it. I'll have times where I make bad decisions too, right? Like in the stock market, where I bought stocks this year, and it looks to me like loan value on those stocks has gone down, dangerously. But that's just a recession. That's what happens when the NASDAQ drops 30%. So there'll be years where you're down, but I have to get a 13% average return to be billionaire. So that's my bucket list goal, and then this is how I'm gonna do it. Okay, back to the Q&A. Hopefully you guys get some value from what I just shared. If you did, hit the like button. What's good, Alex? Thank you for the message. Paul, yes, it is. It's Wednesday. Jonathan, how you doing? William, good to see you on. Hey, how you doing? Just says, hey, Mike. How interested or motivated would you say you are to become a billionaire in your lifetime? I saw this comment. That's part of why I was talking about the billionaire journey. So now I'm finally addressing this comment. Are you more than content with your net worth as of right now? Well, Joseph, I was really content with my net worth in January this year. Well, I was 29. Now that I've turned 30, I've fallen behind my new goals that I've set for myself. Part of that is that, again, I put 7 figures into crypto and into various asset classes that haven't performed well this year. I think long-term, over the next 5-10 years, they will perform well. So I'll HODL. But yeah, I mean, am I disappointed to see losses this year? Yeah, I worked my ass off this year to do lots of flips, lots of projects, and to see that all of the gains I've made this year from all the active projects have been wiped out by all of my assets that just have been devalued by the market. Again, the discount rates have gone way up, right? So when you value an asset, you used to assume a 2 or 3% terminal growth rate. And now it's or cost of funds. And now cost of funds are way higher. So the discount rate, the rate of return investors need, the IRR needs to be higher. And so the valuation on all of these stocks, companies, real estate, businesses, everything's fallen, right? So to be blind and pretend that my properties haven't fallen in value, to pretend that my stocks haven't fallen in value would be ignorant. Of course they have. It's a recession. It's shitty. Ask anyone who has any assets in the market. Anyone who isn't just in cash right now is suffering. If you had 10 properties in London, Ontario, you've been fucked this year. Your 7 figures net worth dropped this year, if you think about it that way, right? So am I content with the fact that my net worth has dropped? No. Psychologically, it really hurts someone I'm a type of person who likes to grow, and I like to outperform. And one of the measuring sticks I use for my financial success is my net worth. It's the largest measuring stick that I use. It's more important than what you make in income. I think it's the most important factor that you have is your net worth. And so, yeah, I mean, it's painful. Financially, it's painful. Emotionally, it hurts to lose, right? So when we dig into the layers, it's if you handed me $5 million and then you took away $5 million, I would feel way more pain losing the $5 million than the happiness I felt when you gave me 5. It's way better to give someone 100 grand, 100 grand, 100 grand, 100 grand, 100 grand, than to give them 5 million and take 5 million away. Give them less net money. You literally give them 5 and take 2 away, and they'll feel shittier than if you just gave them 3. Give them 5, take 2 away, they have 3 net. They'll feel like shit. Give someone $3 million, take none away, they'll feel great. The psychology on loss, on just loss aversion in general. I studied psych in second year. I was a second year psych major at Western. And the classes I took were industrial organizational psychology. I focused on psych in the workplace and how people think and how they get motivated and the psychology behind investing too. It's just man, humans are shitty investors. We are horrible at regulating our emotions, and we allow our emotions and our psyche to mess with us. And that's why robots are better traders than we are for the most part. And algorithms and rules are really important. We need to set those types of parameters up to protect ourselves from ourselves. So getting into the philosophical, the philosophical depths, I guess, behind wealth. To answer your question, yes, I'm content, I guess. My passive income is more than I need to spend, so I don't have to work a job for the rest of my life. So if you asked me 10 years ago, I guess, I just turned 30, so 10 years ago I was 20 years old. If you asked me when I was 20 years old, just finishing at Ivy, getting ready to go into my fourth year, I guess, at that time, if you had asked me if, or I guess I'd be going into third year maybe. I don't know, do the math on that. But 10 years ago, I've been 20 years old, just turned 20 years old. Yeah, so I've been in third year. If you'd asked me then, would I be content with the net worth that I have now and the things that I have now? Hell yeah. Like I over succeeded any of those goals back then. And so I never have to work again. I've been retired for 6 years this February. Retired for 6 years this February. I sort of thought my net worth might just flatline, that because I wasn't working anymore that, things would start dropping, but it just grew like crazy because the extra time allowed me to focus on things I loved, and so I guess the psychology behind it is this loss aversion, right? Loss aversion is pain. Sitting on 200K on HISA, I think that's maybe health savings account or something. Any suggestions on where to allocate? What's private lending rates currently? So dividend, it depends. I think that it's possible that some of the dividend asset classes could depreciate. So let's say a dividend portfolio set up and you're getting with some leverage, you were getting a 10% return, which is achievable in the market. What if those stocks drop in value? Like when you're getting a 6% dividend yield portfolio and the bond market is yielding 9% or 8% with a similar risk profile, you can buy Bell bonds, solid companies, and debt is safer than equity typically. Imagine where those dividend stocks drop 10% in value. You're leveraged, say 2-to-1 on those dividend stocks, you could lose 20%. So the underlying value can wipe out. With lending, the reason I like lending is it's hard to wipe out the underlying principal. You're getting 12% return, almost risk-free. The chance of you losing $1, the property has to fall 25% in value before you lose $1. And so for me, it's it's tough to want to invest in other asset classes like the dividend stocks right now when there's so much potential risk. We aren't at the bottom yet. I think that it's hard because dividend stocks were really attractive last year and the year before. Even in January this year, I downsized my dividend portfolio big time. It was $5 million, now it's $1.5 million in dividend stocks. And the reason I cut so much and redeployed is because I was back then rates were 3%. And so when you're looking at GICs at 1 or 2% and dividend stocks paying 7 or 8, there's a great spread there. It makes a lot of sense. Cost of funds on your profile was 2%, you're getting 7% yield. So the spread was big. Now the spread between dividend stocks and the cost of funds or the other opportunities out there is pretty close. And so dividend stocks are less attractive now. It's weird because capital flocked to safe stocks because they want to stay in equities. But to me, those are not the places you want to put your capital. I would rotate capital out into next year as we have some terrible earnings with some of the big tech. I would rotate capital out of those dividend stocks right now in this cycle and probably rotate it into stuff like Meta. If we see Meta hit $80 a share, it tested in the $90 range, but we see $80 this coming earnings season has a bad earnings season, let's say, and we get $80 a share. We see Apple pull back 10-20% more, Microsoft pull back another 20%. Could happen. If we see that, I'm going to want to rotate out of dividend stocks completely and rotate into tech and into growth because those stocks that have been beaten up, Meta was $300 a share. At 90, that's more than 2/3 of the value wiped out. And I'm just hella bullish on Intel, Meta, names like that, because those solid cash producing companies will be here for the long term. And when rates fall again, the terminal values will change, and all of a sudden now those businesses are much more valuable. And so I think I would pivot out of those asset classes that are yielding the same as you can get, and lending you can get better returns. So it's hard to want the dividend portfolio in this interest rate environment. I'll probably rotate back in when rates fall back down once the tech has ballooned, right? And then we see overvaluation like we were seeing in January. I was having a hard time, even in November, December, I was having a hard time swallowing a lot of those valuations and some of those tech names. And it's like people are trading at 100 times PE ratio. It's like when those valuations come, then I rotate out of those stocks. I'm like, no, I don't want to be part of that. I don't want to chase the hype. I get out and get back into my quality and my cash flowing producing businesses that pay quality dividends for the long term sustainably. But in this market right now, where there's so much instability and potentially more to fall, I think a safe place to be is lending. Park your money in real estate, but park it in real estate in a way that you can't lose using lending. Imagine that. Like with lending, it's like owning the property, but you have an insurance policy that the property has to fall 25% in value before you even lose $1. Market drops 20%. You own the property, your down payment's wiped out. You're doing lending with that same amount of money, market drops 20%, you lost nothing, and you've been making 12% in return. Imagine that. Imagine a stock with no downside that pays a 1% a month dividend. I mean, what? That's insanely good. So if you can craft, architect those opportunities right now in this interest rate environment, it's very attractive to do. It's more attractive now, and dividends are less attractive, and those lower yielding stocks are less attractive than they were, Hopefully that was helpful. Bom, bom, bom. Harriet says, big tech like Google, Amazon. I hold Google, I hold Amazon, I hold Meta, I hold Intel. Those names you're talking about, they're in my portfolio. Do I think they're undervalued? Yes. Is there more to go? Potentially. Could we see another 10, 20% pullback? Yeah, we could. I love those names though. 10 years from now, I think Google's going to be a mammoth. Meta, a mammoth. The metaverse is I know people are scared about 50% of all eyeballs are on a Meta app every month. 50% of the world, we're talking like 3-4 billion people, communicate primarily on WhatsApp, Messenger, Facebook, Instagram. I have friends I don't even know how to communicate with them other than through Instagram, WhatsApp, Messenger, Facebook. Now, I think people are going to start working from home in the metaverse. We're going to have work meetings. We all put on headsets. And so I think because Meta has so much cash and they're so big and they have a huge user base, it would make sense that they gobble up any competition in the metaverse. And it'd be smart, I think, if they're a little early, to be honest. I think the tech isn't quite there yet, but it will get there. And when it gets there, I think the future will be working in the metaverse. People transacting and working in a metaverse environment. So I think that is the future. I'm bullish on that company. But again, I'm not going to bet the farm on it. It's going to be a small allocation in my portfolio. That's all you can do. That's all you can do is be careful and be safe, guys, through these times. Because again, like I said, Meta could fall to $80 a share. I'm convinced that in the next 5 years, we'll see it at $300 a share again. And at that time, I'll dump my shares. Bom, bom, bom. Yeah, I was wondering if you use channel managers, Hostaway, Hospitable, dynamic pricing tools. If so, which ones? I'm largely not involved in operations. I try to make partnerships with people who are largely involved in operations. So in Florida, I'll find partner, et cetera, et cetera. Wherever you are, you want to find an operational partner who's crushing in that area. I like to set up a win-win partnership with them in a way that, we share profit. But there's lots of great dynamic pricing tools. You need to be using one if you're like an individual host with 1 or 2 properties, even 5 properties, doesn't matter. But if you have a large portfolio, you definitely want to be using those types of apps. Yeah, you go read reviews in the different softwares and how they work with your business and how they help you. But 100%, there are some great softwares like you mentioned there, Wheelhouse and other ones that are, you can take that software and you can use it to automate the chat so that it's mostly programmed, automated replies to all of your guests. So if you're individually actually replying to messages on Airbnb yourself, you're failing. You should be automating a lot of that. They have the tools now available in the software that they auto respond to all that. So you're not even involved largely. And there's a process and chain of commands where it goes to a VA to be able to alert you if they can't solve the issue themselves. It's a maintenance issue. They might contact the various people. You give them a series of numbers to call. Most of it can be automated and outsourced so that you don't have to be largely involved. And the good operators are all doing that. So find operators who are doing that. Bwah, bwah, bwah. Next question. I'm gonna do some rapid fire and get caught up because I started, I think, a few minutes late. Point hard to bed here. Oh, there's so many questions. Thoughts on using, okay, what are your chances of getting caught doing STA in regulated markets in the GTA? I don't know. It depends. Usually it's complaint driven. So for the most part, you need a complaint for them to be on your tail. So how good are your neighbors? Do you have good rapport with them? Is someone out there watching and they're gonna report you? It's completely complaint driven. So that's how all the bylaws are enforced, right? Like it's almost all complaint driven. So you got an asshole for a neighbor, that's how you get reported. But in general, the bylaws are there for a decent reason. I disagree with a lot of the bylaws, like how London has a ban on right now entirely, other than your primary residence. So I think that's silly. And I think that the reason they did that is because Marriott is the largest owner of all of the hotels. They have like 3 hotels, I think, in London. And they lobby them for one. And for two, there's the NIMBYs crowd. And they rallied between bribing, probably, and rallying the NIMBYs. The NIMBYs are not my backyards, where they don't want anything happening on their street, in their backyard. We love affordable housing, but not on our street. We love affordable housing, but not in our community. Over here is fine. You know what I mean? Like those kind of people are mostly they're old farts, nothing better to do. They're retired, they've had things a certain way, they don't like change. You know, even if it increases their property value, they feel like it doesn't. And so those people have rallied and said, you know, and rightfully so. I mean, in some respects, I can understand where they're coming from. I try to put on my empathetic hat and I'm like, okay, I can see why it'd be annoying to live next to an Airbnb. It isn't really a housing crisis issue at all. Most of these units don't end up going to the people who need the housing the most anyway. Anyway, let's go back and circle back to that question. So I guess to sum it up, definitely use those dynamic pricing tools. If you're just setting minimum and maximum prices and you're not using tools and software to educate and inform your pricing strategy and automate everything with AI, you're going to be behind the competition. And Airbnb's suffering right now, by the way. People in the middle segment are really suffering. Even in some of the higher end Airbnbs are really suffering. There's a lot of available inventory and not a lot of people are traveling. The really luxe stuff is doing well, and the base stuff, like the 1-bedrooms, studios, they're doing well because people are like, hey, I just want a cheap option. And so that market's still holding strong and the other market's holding strong too. So anything in between is struggling right now on Airbnb with the data that we're seeing. Thoughts on using Adderall to increase productivity? MMA Joey, to answer your question, never used Adderall, so I can't comment. But I have an Adderall-like level of energy. You know, it's like a level of focus, I guess you could say. Like for me, I was just born with the ability to like sit for 4 hours and focus if I need to, and I can turn it off and turn it on, and that's helped me. So I could see how someone born without that would really do well to take something like that. But there are risk factors, man. Like be careful when taking any of those prescription drugs. There are side effects. I have friends who've used that kind of stuff for studying for exams when I was a student. Some of them swear by that sort of thing, teach their own. Anything to do with stimulants at all, like even coffee is a stimulant. I don't drink coffee, period. I don't do stimulants at all. I run completely on like natural, working out can give you a great natural high of energy. Having a nap you wake up and you feel rejuvenated, you can have a natural boost of energy. A little bit of cortisol. Start thinking about things that are stressing you out, or think through some real problems. Get on the smile and dial. I always say, if you need energy, get on the phone. Like find something, you have a tenant you have to call, or something you got to deal with. Get on the phone, your energy levels will spike. For me, that's always been something. It depends on the person. Some people were charged by reading a good book. They come back, they're fully energized, right? So each person is different. I energize introvertedly through quiet time, but then I get pumped up and I get that energy amp when I engage, right? And I perform. So I am very introverted by nature. If I was in front of a crowd right now, I'd be draining the life energy out of me. And this does, in some ways, drain the life energy out of me. And if I get on the phone for a few hours, it does drain the life energy right from me. But I've had the ability to persevere. And so that's, if some people who can't, I guess maybe there's some value in stimulants. Chung, I was actually shorting Meta up until today. So I had shorts on Meta while having longs. And I think the shorts were deeper than the longs. So I was getting a lot of faded decay. It was great. Close that out today. Again, I sell deep covered calls on my position, and then I use that to amplify the return. So I'm holding Meta shares, but I'm also selling covered calls on them. So my covered calls were like $100, I think, ish. And so as Meta, I sold those as Meta was spiking to 120. And so I've made $10 a share to adjust my cost base down. So I might have bought Meta at 120, but using covered calls, I've been able to drop my cost base down to like $100 a share. And so I bought at the wrong time, but through a covered call strategy where I'm selling those covered calls on the down days and I'm buying them on the the euphoric up days, I'm able to basically either generate a 1% return on that equity while the equity stays flat or down, so I can create cash flow. And I can use that cash flow to basically lower my cost base on that underlying equity position. So that's where I use options to reinforce companies I like to hold anyway, where I have the equity. I'll use that to protect it. And the downside, I guess, with covered calls is like you might lose your meta shares. They might get called away on you. In which case, like, too bad. No big deal, right? Like, you just go buy the shares again, make a profit, and go buy the shares again on the next little dip. David says, Mr. Rosehart, would you private lend in a province that has non-recourse mortgages like Alberta or Saskatchewan? I haven't done lending in Alberta or Saskatchewan, but I'm not closed off to the idea. I just don't know the market well enough to have an informed opinion right now. If I could become an expert and spend some time in that market and really understand it, or maybe the deal was so strong that, like, if it's non-recourse, I definitely want to make sure that the underlying asset is super, super strong, great loan to value. So someone came to me with like a $3 million building and they wanted a $1.5 million mortgage on it. Hell yeah, like that makes a lot of sense to me. If you got appraisal and I go look at comps and I can see that it's clearly within the 3 million range and they want $1.5 million first mortgage against that, I would lend against that, no problem. Like, recourse or not, because I've got a solid building that I can take over if they default. So it depends on the underlying asset and the loan to value. To answer your question, it depends. And there's a gray area in between at a certain point where I would say no or say yes. Raz, did you sign a prenup when you get married? I have been with Elise since I was like an adult. Since I was a kid. We've been together since I was 16. So I wasn't even an adult when we were together. I started from nothing. We didn't amalgamate our finances right away. I think we might have been like 20 or something when we started. We were living together before that, but like, I know we really moved in together proper, I would say, like at 19 or 20. And I'd already saved up like 100 grand. I had a stock portfolio when I was like 20 years old. Like, I'd been working aggressively from 16 to 20, making 25 grand a year while going to school and debt free as well, going through school. I had 4 scholarship pretty much. So beyond that, in terms of like divorce, the shares I took into the marriage, we got married, I guess, 2014. We started dating-ish in 2018, I guess. No, sorry, 2008. 2008 we started dating. 2008, so it's been a while. But no, I don't have a prenup signed. She's been part of this journey, and I don't know. I guess a prenup kind of presupposes that you're going to divorce, and we don't plan to do that. I think even if we felt differently, I think that we would still be in each other's life in a way that, like, we have 3 beautiful kids together. We will always be part of each other's life, and for me not to want to take care of her and them, it's just not who I am. Like, I will provide for her forever, and I've accepted that that's part of it, right? That you gotta take care of your wife, you gotta take care of your kids. And I think that thinking about divorce and setting up a prenup is, I mean, it's probably financially a smart decision, to be honest. If any other person was coming to me and was like, you know, should you get a prenup? Yes, probably. If you have good assets, yeah, you should. It doesn't hurt to have one. Doesn't mean you're gonna get divorced by any means, but no, I don't have one. You know, you get around a prenup? Crypto. I'm kidding. Mason says, it's funny, I had someone reach out to me, not recently, but a long time ago, when crypto was pumping, and they're like, I have hard wallets that no one knows about, and my wife doesn't even know about them, and like, blah, 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 and telling me a whole story about how crypto saved their divorce. That's a crazy story. Hey Mike, when you're growing your portfolio, did you buy properties in your personal name or your corporation? So I started using my salary. We leveraged our jobs to buy properties. I bought, I guess, 17 properties in my personal name before I formed anything in a corp, before I did joint venture partnerships. I just did solo lone wolf, built my portfolio, and then I started disposing of those assets and rolling them into new deals. And so originally all my personal name, reason for that is I wanted the deductions. I employed a strategy called the Burr Snowball that I sort of coined, I guess, before everyone was talking about bigger pockets, the Burr, all of that. I called it the Rosehart Snowball, and it was basically just the Burr strategy. But when you buy a Burr property that you need to buy, renovate, fix up, re-rent, and then refinance, you're gonna put a lot of equity gainers into that property, dump money in, dump time in, and then when you dump the money in, your first year and your second year of owning a property that you're stabilizing, there's a lot of vacancy because you kick tenants out, there's a lot of losses, you're dumping money into repairs and maintenance. As you turn that building around and put good tenants in, you're in a loss, big time. Typically at $20,000, $30,000 per year for the first 2 years in that property. you can take that income if it's in your personal name and offset it against your day job. So I paid no tax for those 3 years I worked full time almost, because the rental, at least in the second and third year, because I had rental properties that were all cash flow negative on paper. And because you can then refinance out the capital tax free. If you're covering a bunch of maintenance and you're improving the property and it's vacant, you might have a lot of expenses like mortgage and utilities, all that's still happening, property taxes, insurance, all of that's still accruing. And you're in that time you're stabilizing the asset, you're in a big loss. You could, in theory, be in a position where you're paying no tax. You pay 100 grand a year, have some personal properties that offset all of your day job income, because again, the rental net income or loss is directly full marginal tax rate, offset or taxed. So in the beginning of your journey, buy them in your personal name for sure. Cheaper insurance, cheaper mortgage rates, easier mortgages, better tax advantages in the beginning of your strategy. And then move into a corporation. Although there are exceptions to the rule. If you're joint venture partnering, as an example, don't do it in your personal name, ideally. Set up a corp structure. It depends, I guess is the answer. It depends on your income level, depends on where you're at in your journey. But you can, in theory, use real estate as a great tax vehicle to build up wealth and defer the taxes of the capital gains sale of that property to the future when you're already rich. And in the years when you're accumulating and building wealth, you could have negative income. So you can offset day job income and work a full-time job and pay no tax. So you can get 100 grand a year and pay no tax, get all that money from that salary, reinvest it into the property where it grows tax advantage, tax-free, because you can then pull the new equity you've created out of that property out in a tax-free refinance and then put that to work and buy more assets. And that's a really great way to accumulate wealth. So real estate's a really great tax-advantaged wealth builder in your personal name in the beginning for most people. Depends on where you're at in your situation, but it can be in the type of strategies you're using. If you're just buying a turnkey property, it's different than if you're buying assets you need to stabilize. Because again, the turnkey property will be producing cash flow. That will mess you up if you got a great job. You're already at a 50% tax bracket. So there's not a lot of advantages of having your personal name. Maybe better to defer things in your corp. So it depends is the answer. There's also liability risk too. You need really good insurance policies and things, because you can make a lot of mistakes in your personal name. You can get sued, especially if you're just starting out. All right, I need to go faster here. I'm way behind these questions. Okay, where was I? 2 to 4 units, appraised value, not valued, get small amount of equity, take out, how to make a BRRRR work. So Andrew, just buy better deals. The short answer is you have to buy under market to make a BRRRR work. So if properties are selling at those rates, you have to basically just get them at lower rates. So go to a private person and say, hey, you can find a deal where someone's got a really bad tenant, like the worst tenant you can imagine, just a druggy. I know landlords who have been physically assaulted. They went to see the tenant punched him in the face, like bleeding. That landlord, they're gonna sell it right now for 400 grand, even if the property's worth 500, because they know they can't do showings in that property because that tenant's crazy. They don't want to deal with that tenant ever again. Money isn't even important at that point, just like getting rid of that stressor. If you'll take that stressor on, you'll deal with that SOB tenant, you can get a great deal, right? So it just depends is the answer. Look harder. If it was easy to BRRRR and make 100% return on your money in a year in real estate on your down payment, everyone would do it. It's not, it's hard. They're hard to find. They're findable, there's lots of them. I'd say about like 5% of the real estate that's transacted is solid BRRRR. So that means that like probably 9 out of 10 deals don't meet your metric, but 1 out of 10 does. If you know where to look and how to look, you can find them. I continue to find them. A lot of it's networking. A lot of it's hunting, and knowing what you see, knowing when you're looking at a deal, if it's a deal. Because sometimes I see people look at deals and they don't see it as a deal in the same way I do, because they do not see it from the same lens of how to reposition that asset. Is there a severance you can do? Is there a way you can add another unit that they aren't seeing? You can add some bedrooms to it. Maybe it's a great student rental and it just needs to be repositioned from a 3-bedroom to a 5-bedroom. And it's like, that's 2 walls and some drywall. It took a 10 grand. And you reposition this asset so it's worth 80 grand more. You know what I mean? There's ways to, maybe it's got a bad tenant in it. It's paying low rent on the property. You know how to get in there and get the tenant out and restabilize the unit and renovate it, make it bougie, and now all of a sudden your property's worth 200 grand more. So those are ways you can do it. How's living off only real estate cash flow when you're financially free? Derek, it sucks. I definitely want to have multiple sources of income if you can. Real estate income feels like it might be stable, but it's very unstable. You need lines of credits, you need emergency funds. I use lines of credits as emergency funds. unsecured line of credit, go to the banks before you quit your job. You can go apply for 3-4 of them at once right now, and every bank will give you 50 grand. Most people with a regular job, they give you a half times your salary, 1 times your salary as an unsecured line of credit if you have no other line of credit debt. But you can go apply for TD, RBC, BMO, Scotia, all of them at once. And it all hits your credit score at once, so none of them see that it's happening. I don't know if that's legal, but you could, in theory, apply. Maybe someone will decline you. Maybe a few will approve you. I know people who have done it at like all the credit unions and banks and set up like $50,000 line of credits before they quit their jobs. And so they have $250,000 in unsecured debt across, the banks. And so that's a good backup that you can use to live on. If you'll have good months where like no maintenance comes up. You'll have bad months where like a tenant destroys a unit. You have to spend $5,000 to fix the unit up and re-rent it. That's a bad month. And that month, that property's gonna be way negative cash flow and drag down the cash flow from your entire portfolio. Maybe you have a furnace that breaks. Maybe you'll have a roof you need to do. Maybe a tenant doesn't pay rent for 2 months. Things happen. And there'll be good months where you make a lot of cash flow. There'll be bad months where you don't. So the cash flow is very irregular in real estate. And people think it's like they write their cash flow, they go, it's $600 a month. It's gonna be $600 every month. No, some months it's $1,200. And some months it's like negative 200. So that's the reality of real estate. That's why having a lot of properties, a lot of units helps you to stabilize that. Because over a large portfolio, it doesn't all go sour at once. So when some months are bad, other properties are doing really well, better than expected. And so it all balances itself out, right? Some properties have zero maintenance that month. So that maintenance allocation that you set, that can be used for another property. And so then the cash flow can balance out. So I've done it, I've lived on it, it can be done. You can also live on dividend income, it can be done. Yeah. That's what I got to tell you. Keep reserves. Harriet says, what cap rate do you think is realistic in Toronto? Well, realistically, it depends on which areas of Toronto. Like if you're in proper like downtown, there are properties, like really nice properties that'll sell at 2 cap rate. I don't know how that makes any sense. I don't know why people want to own that. There's gotta be emotional reasons because the math doesn't support it. It's cash flow negative. It depends. Some people use student rentals who crank out a bunch of bedrooms in the property and they're able to, in the GTA, squeeze out like a 9 cap. And some of that comes through them buying an asset that needs to be revitalized in some way, right? So that's them getting a deal on the property that helps them get that higher cap rate, and they're repositioning the asset in some way to get there. Okay. But your own bank with a whole life insurance policy. Be careful with whole life, guys. It can make sense. A lot of people get sold into whole life that shouldn't have whole life. It is really a great product if your tax rates are high and you can use a third-party lender like a bank to come in and securitize that policy and let you borrow back the cash value. And they set it up in a way that your cash value is high in year 1, year 2, etc. So that's what I would say about that. Yuri says Meta is spending way too much money on R&D. Might pay off in the long term, but odds are many more growth companies will be booming sooner. They are probably 5 to 10 years too soon. So I don't know. They have a lot of cash, and I agree. It's great that Zuck is stepping back, and we're seeing some of that development. I think they're investing in the right areas. I like the company. They shouldn't invest. You're right. They're investing too much in R&D. It's true. It'd be nice if they invested less and they gave more cash flow to the investors. I think a lot of us investors in Meta see that they're a cash flow machine and a market dominator and see the opportunity there. They're one of the largest, like the FB marketplace as an example, is like the place where you buy and sell everything. They're like the largest exchange of used goods, right? Like it's huge. There's just so much potential there with what they're doing right now and what they could do that I'm still so bullish on the business, and I love it. And it's trading at enough of a discount to earnings that they can make a few pivots and just be cash machines if they wanted to. I think the metaverse is the place that they need to focus, because every company these days needs to be focused on the future of growth, and that's the way they're going to eat lunch in the future of other companies. And they could just buy their competition too. Like instead of R&D, they could just take the cash and use it to buy any competitor who makes a better product than they did with Oculus. Now, Oculus wasn't a good buy, but something like that. Michael says, are you ever going to go into commercial real estate? Probably not. Maybe someday. I'm not gonna say no, but it's very difficult to find good tenants. And I think that there's a trend against commercial real estate. So we're seeing less people do brick and mortar stores. We're seeing less people go into the office. We're seeing less of everything in the commercial world. So I see commercial real estate being flipped to residential as population continues to grow and there's less demand and people work from home. They need more home space. And so I think commercial properties will be pivoted and sold as residential units. That's my thesis. So I might buy a plaza and convert some to residential and keep some commercial if I had a really great flagship tenant. The rights are great. But look at Alberta as an example. I just figured this out. I had a lunch with Mark Loeffler. He was telling me all about Alberta. I didn't know this, but in Alberta, you can just, like, when the lease is done, you can just raise the rent. Like, if the rent's $1,000 a month, you'd be like, hey, I'm gonna give you a notice. Your rent's now $2,000 a month. You buy a building, you buy a 50-unit building, you're like, hey, the rent's up $300 every single unit. Paid or leave. And you can just evict them. So in Alberta, like, tenants have no rights in comparison to like Ontario, where like they have all the rights. It's their property, not yours. And they live in your property, they tell you how it goes, right? Like, Ontario is a horrible market to invest in from a landlord-tenant board RTA perspective. Residential Tenancy Act is really strong in favor of the tenant. So Alberta's a different world. It might attract me out there. It's what the property rights are so strong in Florida as well. Florida's even stronger than Alberta. And that's what attracted me to Florida too, is like, well, one, the beautiful weather, especially in the winter. It's like where I want to be, and I want to be investing where I am. And yeah, I think Alberta's an interesting market. So it depends. In markets like Alberta, Chung, it's really, you know, you don't have, it's a lot like commercial real estate because you're in control as a landlord. It's your asset. People pay what you tell them to pay. Desmond says, hey, Mike, can you share how you were able to acquire property in the Muskoka? That one was yeah, that was a great deal. I picked up a over 1,100 square foot bungalow with like 12-foot cool vaulted ceilings. It's like a circular, really cool building. It's like a 3-bedroom cottage year round. And it's just across from the lake. I think it's water views. It's got a bunkie house. All of that is a nice bit of land for 192 grand. The ARV is like 500. It's a great deal. I'm super thankful that a lot of that was like my network or my brand. And I called the wholesaler, knew them, and we were able to just strike a deal. And it was like I bought it sight unseen. And I'm like, hey, I have cash, and they know who I am. So if any other person was interested, I'm the better buyer. I have a trajectory of, you know, on my way to billionaire, right? So doing deals with me will lead to future deals and future business. And doing a deal with me, you get a guaranteed sale. Wholesalers are afraid that like some random buyer calls them up who's never done a deal before, and they want to go see the property, and they're annoying, asking a lot of questions. Who are they going to sell the property to? So a lot of it is my approach. I'm an experienced real estate agent, real estate investor, decade of experience. People can look me up on YouTube. They know who I am. They know I'm a closer. I've done 100 deals now. I've never backed out on a closing, ever. So I always make closing. I don't push things off. I'm the guy who gets it done. And so that's why they want to work with me. Even if the price might be less than they can get from someone else, they're like, I'd rather do a base hit and go on to the next deal. Do a base hit with Mike Rosehart and go on to the next deal. Then take a risk and make a little bit more with someone else. So we're excited for that deal. Yeah, it's going to be a good one. Well, what is this channel? First time here. Tim, welcome to the channel. Tim Smith, welcome. Hopefully hit the subscribe button, hit the notification bell. We're live every week, 7 to 8 p.m. Or 7 to 8 p.m. Eastern Standard Time-ish, give or take 15 minutes. Sometimes I go a little late, but yeah, welcome to the channel. Thank you for joining. We just, last 5-6 years, I've been sharing on Facebook and on Instagram and on YouTube now for, I don't know, my first videos were with Graham, I think. Graham Stephan back in the day. He's at my house, 2018 maybe? 2017, 2018, in that range. So we've been doing videos for a long time, and it's been fun to see, you know, all my peers succeed in the space, like Graham Stephan and Kevin. Kevin's channel has also been blowing up. Both those guys have just done so well. I'm super proud of Matt McKeever, a lot of friends. He got me into YouTube. So it's been great journey. Welcome to the channel, and hopefully you learned something, and chime in. If you want to learn some more, you can jump in. Is this guy from Nickelback? What's he talking about? Sounds like a Martian. Well, thank you for that. I don't know. Nickelback, that's, I guess that's a compliment. He's a famous rock star, so I'll take it. Raz says, does investing in Meta not conflict with Christian morals? Meta to me seems pretty evil. Hope they do poorly, no offense. So for me, it's about finding businesses that are cash flow kings and that have a market dominance and a large moat. And I see a huge moat around Meta. There's no one that comes close when it comes to social media. Do I think that social media in general is bad? I don't know. I think that you can definitely invest in stocks. Like, there are lots of people who use social media platforms that are Christian to promote the belief in God, to find people who wouldn't have otherwise found God. So, I mean, Facebook Instagram, they can be tools used for good or evil. No, it doesn't stop me from investing. I think God wants me to do what is best for humanity, and I think that honestly, having social media and having technological advancement is good net for humanity. We're living longer, better lives, more socially connected. There are flaws, don't get me wrong, but I'm gonna chase the profit. I'm gonna invest where there's market dominance, and Meta is one of those examples where I just think that they're a beast in the communications space. They are the future of facilitating communication, and so that's what they should do. I think that the whole, in this pandemic, we saw this push from government. I don't think Meta really wanted to do it. I think they were forced by institutions and forced by government to intervene and forced to fact check. It's kind of hard when authorities are calling you and telling you have to censor this information or they're going to sanction your business and shut you down. So blame the government. Don't blame the private corporation that's appeasing the government so they can continue operating. They have to work within the confines of the current system. And the system's not great, but it is what it is. And so if you're angry, get angry at your politicians, get angry at your government and the lobby groups that are getting out there and doing this, right? So next question. Good to see you on every week. Question would be buying pre-construction. Yeah, I mean, you could buy pre-construction. It is discounted. I think it might be more discounted into the future. The logic has to be with pre-construction, what do you do once you get assigned that property? You're going to just sell it, maybe at a loss, because the market could dip further. You're speculating. And so I don't love speculating. It's a crapshoot whether real estate comes back in the next short term or stays flat or goes down. Over the long term, for sure. But new builds, for the most part, don't cash flow well, especially new build condos. Just in general, most new builds don't cash flow well. So if you want a nice, brand new, quality product, typically you're not going to get great cash flow with that. You got to buy the more beat up duplex, triplex, 20 unit, 30 unit, older stuff. Cash flows better and sells at a bigger discount. New stuff sells at a premium. But maybe you can find a builder that's going out of business that's going to do a great deal and you pick up a property and finish it off. That would be interesting. But just be careful. I don't know. There could be more pain ahead. At the same time, you're right. People are afraid. Rates are high. You might be able to score a deal, and if you're lucky and you speculate and the market pivots and rates start coming down next year towards the end of the year and all of a sudden there's demand, then yeah, you made a good investment. But again, it's a bit of speculating and there's not a lot of cash flow to back it up. Have you ever sold a covered call and had the share price shut up, but the buyer forgot to call the shares or something before the expiration date? No, for the most part, interactive brokers and most of the brokerages will automatically settle for you. It automatically settles. I've never seen it where it didn't automatically settle. I can't think of a situation where that's happened to me. Can't think of a situation. Monster says, big move coming next week in the stock market. Are you short? Monster, I don't know. Do you mean big move down or big move up? We could see, I would say the majority of investors are banking on a Santa rally. Could happen. Right now, I'm completely neutral. So I'm not long, I'm not short. I've closed off most of my shorts with longs. So we'll see what happens. I'm waiting to buy the dip. But if I see a little rip, if I see we get a little bounce up here, I might put my shorts back on again. Raz says, do you have a personal chef and cleaner or do you do cooking yourself? We do a lot of our own cooking and cleaning, but I do have a nanny that helps clean and does some cooking and that sort of thing too. Yeah. Derek says, what do you think is the best way to be financially free? Work your ass off as some sort of business where you can develop a competitive edge and then save as much as you possibly can at whatever it is that you do. Even if it's a full-time job, find a way to save a lot of it. And if you aren't saving enough, you need to be either earning more money or spending less. Probably both. Whoa. How do you start a conversation with a realtor? Call a lot of realtors. Talk to as many as you can. Yeah. I'm not a buyer of Tesla. I think that they might get the other manufacturers of electric cars are catching up and might start eating their lunch. I love Elon Musk. And I love what he's doing and I love what he's done. But it's a long shot to think that he'll be able to continue outperforming all of the other auto manufacturers. into the foreseeable future, it's possible they could dip further. They're also a big growth company trading at a high multiple. So in this interest rate environment, not a great play right now, but could be a good play at the bottom of the market if as rates fall, if rates fall in next year, could wait till 2024, 2025, then I think there'd be an interesting play on growth. But be careful, that's all I would say. Welcome to Alberta. Thanks for being here. Hey, Juan, no problem. Always here to help. All right, I gotta go. The secret to unlocking a wealthier you is spend less, earn more, and I'm coming, Jonas, relax. How low can we put on? So it just depends. You gotta talk to the realtor. It depends on the comparable analysis. Remember, spend less, earn more, maximize returns and the difference, everyone. And have a great night. We'll see you next week. I gotta go.